Saving capital gains with Section 54 EC bonds. Section 54 EC of the Income Tax Act provides a way to save on long-term capital gains tax when you sell certain assets, particularly immovable properties like land or buildings. By investing the capital gains into specified Section 54 EC bonds, you can claim an exemption from paying capital gains tax. Here's a detailed breakdown of how this works. Key features of Section 54 EC bonds. Eligible assets for exemption. Long-term capital gains from the sale of immovable properties, such as land or buildings, qualify for tax exemption under Section 54 EC. The gains must result from the sale of capital assets held for more than 2 years. The section does not apply to short-term capital gains or gains from other types of assets, such as shares or mutual funds. Specified bonds. The government issues Section 54 EC bonds through specific institutions like the National Highway Authority of India, NHI, and the Rural Electrification Corporation, REC. These bonds are secure, non-convertible, and redeemable after a fixed period, 5 years. The investment in these bonds allows you to defer or avoid paying capital gains tax on the sale of property. Maximum investment limit. The maximum amount you can invest in 54 EC bonds in a financial year is rupees 50 lakh. If your capital gains exceed rupees 50 lakh, the exemption applies only up to this limit, and the remaining capital gains will be taxed. Example, if you have rupees 75 lakh as capital gains, you can invest rupees 50 lakh in 54 EC bonds and save tax on that portion. The remaining rupees 25 lakh will be taxed. Lock-in period. Lock-in period for these bonds is 5 years, previously 3 years. This means the bonds cannot be redeemed or sold for 5 years from the date of investment. You cannot transfer or sell these bonds before maturity, and premature withdrawal is not allowed, providing tax exemption benefits only if held for the full tenure. Taxability of interest. While you get an exemption on the capital gains, the interest earned on 54 EC bonds is taxable under your income. The current interest rate on these bonds is relatively low, around 5 to 6% per annum. But the primary benefit comes from the tax saving on capital gains. Time limit for investment. The investment in 54 EC bonds must be made within 6 months of the transfer or sale of the asset to claim the exemption. If you fail to invest within the 6-month window, you will lose the benefit of this exemption, and the capital gains will be subject to tax as per applicable rates. Non-transferable. These bonds are non-transferable and cannot be pledged or used as collateral for loans during the 5-year lock-in period. How to calculate exemption under Section 54 EC. Here's how you calculate the capital gains tax exemption using Section 54 EC. Step 1. Calculate capital gains. Suppose you sell a property for rupees 1.5 crore. The cost of acquisition, original purchase price, was rupees 50 lakh, and after accounting for indexation, adjustment for inflation, the indexed cost of acquisition is rupees 75 lakh. Capital gains yield or sale price, indexed cost of acquisition is rupees 1.5 crore. Rupees 775 lakh yields rupees 75 lakh. Step 2. Invest in 54 EC bonds. If you invest rupees 50 lakh out of the rupees 75 lakhs of capital gains into 54 EC bonds within 6 months, you will save tax on this rupees 50 lakh portion. Step 3. Exemption on proportionate gains. Since you invested rupees 50 lakh out of the rupees 75 lakh total gains, your exemption will apply to this amount. Proportionate exemption is clear. Invested amount, total capital gains. X capital gains. Therefore, your exempted gain is rupees 50 lakh. The remaining rupees 25 lakh will be subject to long-term capital gains tax at 20% after indexation. Conditions for claiming the exemption. Property sale. The exemption is available only if the gains are from the sale of a long-term capital asset, like land or buildings. Timeline for investment. You must invest in 54 EC bonds within 6 months of the sale of the property to claim the exemption. Limit on exemption. The exemption is capped at rupees 50 lakh per financial year, which means you can invest up to rupees 50 lakh and save on capital gains tax up to this amount. Retention of bonds. The bonds must be held for the entire 5-year period. If sold before this period, the exemption is withdrawn and the capital gains become taxable in the year of sale. Advantages of investing in 54 EC bonds. Tax savings. The most significant advantage is the ability to save capital gains tax by reinvesting the proceeds in specified bonds. Safe investment. These bonds are government-backed, offering safety and security to the investor's capital, though the interest rates may not be as high as market-driven investment options. No risk of market volatility. Unlike stocks or mutual funds which are subject to market fluctuations, 54 EC bonds offer a fixed return, making them a safe option for risk-averse investors. Ideal for large gains. If you have a large sum of capital gains from the sale of property, investing in these bonds allows you to save on a significant amount of taxes while still earning interest. Disadvantages of Section 54 EC. Bonds, low interest rates. The interest rate on 54 EC bonds, around 5-6%, is lower than what you might earn in equity or other higher risk investments. Also, the interest is taxable. Lock-in period. The lock-in period of 5 years can be a disadvantage for those looking for liquidity. You cannot sell or pledge the bonds during this period. Limited investment amount. The maximum amount you can invest in these bonds is rupees 50 lakh. So if your capital gains exceed this amount, the rest will still be taxable. Conclusion. Investing in Section 54 EC bonds is a smart way to defer or avoid capital gains tax when selling long-term assets like property. The investment is safe, government-backed, and provides tax benefits, though the low interest rate and 5-year lock-in period may not suit everyone. It's particularly beneficial for risk-averse investors who prioritize tax savings over high returns. If you plan to sell a property or long-term capital asset and want to maximize tax savings, these bonds provide a strategic option worth considering.